Welcome to the gallery, is where knowledge knows no bounds. In today's rapidly evolving economy, raising capital is crucial for driving economic growth. While banks have traditionally been the primary source of capital for firms, the modernization of the Indian economy, coupled with capital constraints faced by banks, has given rise to alternate methods of capital raising. One such method is through initial public offerings, or IPOs, which provide companies with the opportunity to go public and raise capital through the issuance of shares. In this video, we will delve into the world of IPOs, exploring their definition, benefits, process, and different ways of filing IPO applications. Let's start with the basics. What exactly is an IPO? An IPO, or initial public offering, is a process through which a company offers its shares to the public for the first time. It allows companies to raise capital by either issuing new shares or allowing existing shareholders to sell a portion of their shares to the public. Now, you might be wondering, why do companies choose to go public through IPOs? Well, there are several reasons. Smaller and newly incorporated companies often utilize IPOs as a means to raise funds for expansion. On the other hand, larger privately owned companies opt for IPOs to become publicly traded entities and strengthen their market presence. Going public through an IPO offers numerous advantages for companies. Let's take a look. Advantage number 1. Utilization of funds. The money raised through IPOs can be utilized by the company for various purposes, including growth, expansion, acquisition, and working capital requirements. Advantage number 2. Increasing liquidity. Going public enhances liquidity for equity holders, providing them with the ability to easily buy or sell shares in the market. Advantage number 3. International credibility and visibility. A listed company gains international credibility and visibility, attracting potential investors and business partners. Advantage number 4. Increase in market share. Going public can lead to an increase in the company's market share, strengthening its competitive position. Advantage number 5. Cheaper access to capital. Publicly traded companies have access to capital at potentially lower costs compared to private entities. Advantage number 6. Strengthening or diversifying equity base. An IPO can help strengthen or diversify the company's equity base, providing stability and flexibility. Advantage number 7. Employee motivation and retention. Companies can motivate and retain employees by offering stock options, aligning their interests with the company's performance. The benefits of IPOs. Now that we have explored the advantages for companies, let's talk about the benefits of IPOs for both companies and investors. Benefit number 1. Companies can raise capital quickly from a large number of investors, facilitating business expansion, research and development, and meeting working capital requirements. Benefit number 2. Listed companies gain prestige and credibility, attracting talented individuals and fostering growth. Benefit number 3. IPOs provide opportunities for investors to participate in a company's success by offering the potential for capital appreciation and dividends. How does an IPO work? Now, let's walk through the process of conducting an IPO. Step 1. Registration. Companies must register with the Securities and Exchange Board of India (SEBI) to file for an IPO. Step 2. Determining offer details. Companies determine the number of shares to be offered and the price or price bands at which they will be made available to the public. Step 3. Investor subscription. Investors subscribe to the shares offered by the company. Step 4. Partial allotment. In the case of oversubscription, the company may offer partial allotment to its investors. Step 5. Listing on stock exchange. After the shares are issued to investors in the primary market, they get listed on the stock exchange for trading. Different ways of filing an IPO application. Online mode. The most convenient way to apply for an IPO online is through a 3-in-1 account provided by banks. Step 1. Open a demat account and trading account with a financial institution that offers online IPO application facilities. Step 2. Log into your trading account and select the IPO you wish to invest in. Step 3. Transfer funds from your bank account to your trading account. Step 4. Choose the number of shares you want to apply for, set the bidding price, and submit your application. Step 5. If you receive an allotment, the shares will be credited to your demat account, and the blocked funds will be debited from your account. Offline mode. For offline IPO applications, investors must follow these steps. Step 1. Collect an ISBA form from designated bank branches. Step 2. Fill in the required details on the form, including your name, PAN number, demat account number, bid quantity, and bid price. Step 3. Submit the form to the designated banking branch, instructing them to block the amount in your account. Step 4. Ensure the accuracy of the information filled in the ISBA form to avoid rejection. Step 5. For applications exceeding 50,000 rupees, attach a photocopy of your PAN card. Investors must note that shares can only be issued in dematerialized form, so having a demat account is essential for IPO applications. Understanding the IPO process and the different ways of filing applications is essential for investors looking to participate in these offerings. Thank you for watching this comprehensive guide to understanding IPOs. If you found this video helpful, don't forget to like, share, and subscribe for more informative content. Happy investing!